Welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management and host of today's show. My co-host is Audrey Greenberg, co-founder of Centers for Breakthrough Medicines. And our guest today is Chuck Baldwin, who is the co-founder and principal of Baldwin Clarke Companies. They provide personal financial advisory services. Well, hello, Audrey.
Hi, Mike. How's it going?
Pretty good, thank you. Yeah, it's great to see you again. And I have a question. I see in the news that you've recently entered into a SRA sponsored research agreement with the University of Pennsylvania at the Centers of Breakthrough Medicine. And what does that mean?
Yeah, we did. We announced that just a few short months ago. We're very excited to be partnering with the gene therapy program at the University of Pennsylvania, run by Dr. Jim Wilson, MD, PhD, and really one of the inventors of gene therapy. And the Center for Breakthrough Medicines is partnering with the gene therapy program through this sponsored research and joint manufacturing agreement, where we are able to license the current technology that Dr. Jim Wilson and his team developed and offer that to other biotech companies that are looking for a way to make gene therapies. So it's a way to sort of speed their way to clinic and to the patient to help them fast track their process. And really get therapies to patients more quickly. So by licensing this Penn platform, it comes with all of the University of Pennsylvania know-how, their analytical methods, which are really tests that prove things that the FDA needs to see, and all of their materials and processes. So we're really thrilled to be partnering with Jim and his team and offering this platform to companies that are looking to speed their path to the patient. And we also have a joint manufacturing agreement with Jim and his team, whereby we have a GMP suite that's a clean room where you manufacture these therapies, and we're splitting capacity 50-50 with them. So Penn is able to bring all of their partner companies into our suite to manufacture. You know, manufacturing capacity is really hard to come by right now. So having standby capacity really helps these companies reduce their wait times and partner with a CDMO. We're a contract development and manufacturing organization that has done this before with a team that's done it before. And so thanks for asking. It's an exciting time at CBM.
What was UPenn doing prior to the agreement with you? How were they commercializing these inventions, these developments that they had?
That's a great question. So a lot of this is very novel, right? So gene therapy has been going on for some time, but the first approved gene therapies were really just in the last couple of years. The first of which was Spark Therapeutics drug Luxturna. And so anyway, now we have a handful of approved gene therapies, but most of the technology that's spun out of University of Pennsylvania is done through and manufactured at outsourced providers, meaning Penn does not control that process. So having this dedicated capacity with Penn, where we can split the suite 50-50, allows them guaranteed standby capacity for those that partner with Penn, where in the past they'd have to go to external providers. And it allows us, for the first time, we're the only CDMO that can offer Penn's technology and license that to.
I was going to ask that. You say that you're the only one. It's sort of an exclusive arrangement then, or are you competing against other firms that are licensing this as well?
Yeah, no, we're the only contract development and manufacturing organization that is offering this technology for companies to license. So we're excited about that exclusive relationship.
So this will enable people who want to use their technology, because you already have capacity as far as manufacturing and creating drugs, products, whatever out of this, the ability to spool up almost immediately then, I guess, right?
Yeah, I mean, it's not just having the space and the expertise on hand to make these therapies. It's also having this, what we call a platform, right? So a lot of times you have scientists that develop therapies in academic labs, and they don't have a way to efficiently scale or test their therapies. And so having a platform that they can license from us, this Penn platform, which has been proven effective with the FDA, and being able to license this platform to manufacture their therapy allows them to save at least 6 months of time, really, so that
Wow.
they don't have to develop their own bespoke platform to manufacture their product. So that's the first thing. And then obviously having that capacity to do it and the expertise that knows how to do it. So really it's a way for these innovator companies to focus on cures and developing new therapies rather than figuring out how to get them made and how to scale up and what analytical methods. Everything is sort of an out of the box, ready-made solution so they can focus on that next generation of cures.
And how many other relationships like that do you have or anticipate? It seems like this is a model just rolling out.
Yeah, that's a really good question. So we are in conversations with other academic institutions, and we look forward to announcing some of those sort of in the next 6 to 12 months. But there is a lot of cutting edge technology out there, not just in the AAV gene therapy space, but in many other ways that address the needs of people that are suffering from cancer and some other inherited diseases that potentially can be cured with gene and cell therapy.
Wow, that's phenomenal. That's great. Okay, yeah, I'd like to move on to, we have a viewer question, or an audience question, sorry, from Janet Wellington in Philadelphia. What about the health risk from genetic engineering, such as antibiotic resistance? How would you respond to that?
Yeah, Janet, thanks for sending in your question. So antibiotic resistance is really not associated with genetic engineering, at least to the best of my knowledge. But what antibiotic resistance really results from is the overuse of antibiotics and patients that unfortunately don't finish their full course of antibiotics. So please make sure you finish your full course of antibiotics. Don't overuse or over all the doctors out there overprescribe antibiotics. And make sure that we don't have these antibiotic resistant bacteria thriving out there in the environment that can really morph just much like COVID can. So let's take our precautions there, but certainly not associated with genetic engineering.
Okay, well, thank you very much. And if you are interested in sending in your question, here's how to send your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, now we'd like to bring in Chuck Baldwin, who is the co-founder and principal of Baldwin Clarke Companies. They provide financial advisory services. Hello, Chuck.
Hi, Mike. How are you? Audrey, how are you?
Doing well. Great to have you.
Doing great, thank you. So I want to open with a question. You've been at this for more than 50 years, and you've gone through a number of bull and bear markets, high inflation, a variety of environments through that time. And based on that experience, is there any general guidance you might offer to investors today?
Yeah, a few points, and I'm really addressing these to long-term investors as opposed to traders, obviously. And something to keep in mind, if you're 65, you still have a long-term investment horizon, given life expectancies where they are today. Certainly a husband and wife, 65, their combined life expectancy is out to 85 or 90. So you're all long-term investors in reality. But a few points. One, corporate earnings in the long run drive stock performance. Shorter term results are driven largely by investor sentiment and investor reactions to headline news. Bottom line there is don't follow the crowd, rely on the long-term performance of good performing companies to carry the day.
Are you saying, Chuck, I should stop following Elon Musk on Twitter?
Yeah, good point.
I thought he was moving the markets. I thought he was the guy.
Well, that's just that he is moving the market. That's the very issue. So you're right, Mike.
Right.
also clearly stay very well diversified with U.S. and international equities, different forms of fixed income, also for equities, mixed value and growth styles. So you're really covering the range of potential market exposure. Above all, don't try to time the market. Stay invested. Interestingly, for the last 20 years, if you had invested in the S&P 500 and missed the best 10 days over that 20 years, your returns would have been 54% less than the S&P return over that time period. And if you missed the top 25 days, you would have lost 78% relative to the actual market performance. Interestingly, too, over the last 20 years, if you miss over the last 20 years, 24 out of 25 of the worst performing trading days were within 1 month. Within 1 month, we had the 25 best trading days.
Huh.
So you tell me when you should go in and out and so on. We don't know. We don't know.
Right.
So,
You just hit those periods where you have just enormous upticks in volatility, the market just gyrating all over.
yeah,
There's really no way to market time that.
right.
Exactly. Yeah.
We do suggest keeping some cash on hand so that when there are dips in the market, you have the opportunity to buy on the dips. Importantly, don't go it alone. Hire a professional advisor who can develop a asset allocation unique to your circumstances, and then populate it with the best investment options for you, be they index funds, ETFs, mutual funds, separate account managers, and so on. The studies are very clear that investors who go alone don't even come close to what investors earn if they're working with advisors. So those are I think the key things that we've come to learn over these 50 years.
Yeah, Chuck, I saw that you wrote a blog a few months back suggesting the historical classic 60-40 stocks bonds portfolio might be dead. And I'm just curious, why do you think that's the case? And what does that mean for investors and folks like me that are out there trying to make a buck in the market?
Well, that's a great question. And we're not alone in feeling that way. Importantly, we and other firms as well build portfolio allocations based on what we think is going to happen in the future, not on what's happened in the past. Now, of course, what happened in the past informs what we think will happen in the future, but the forward-looking capital market expectations for all the leading investment management firms are for very muted returns in both equities and fixed income. We utilize the 10-year capital market projections developed by Cowen Associates, who we've worked with for 35 years. They're a leading national investment advisory firm. They advise trillions of dollars of assets. And looking at their research, their expectation for broad U.S. market equities, the return expectation compounded is 6.6%, 6.8% for international equities, and as little as 1.75% compounded for fixed income. So when you combine that notion to a 60-40 portfolio, the expected return that you get from, we just took 60% S&P, 60% fixed income, the expected return is 4.6% compounded over the next 10 years.
Yeah,
go through the same exercise, they came up with 4.7%. So JP Morgan, Morgan Stanley, we're all in that same boat. So that it raises the question you asked, Audrey, what does that mean for investors? And really to provide some context too, if you had been invested in the S&P 60-40 for the last 10 years, your return would have been 7.1%. So we're talking about a dramatic change from what we've experienced in the last 10 years. With bonds offering negative real returns, inflation, by the way, is assumed to be 2.25% by Callan. Others are pretty much in the same boat. Some are at 2.5% over the next 10 years. So look at bonds, you've got a negative real return of 50 basis points. So what do? You're trying to get a decent return. Do you go to 100% stocks? Well, most investors shouldn't take that amount of risk and don't want to take that amount of risk. So it's really a problem. A few things they either need to learn to live with the idea that they're going to earn less, or understand that their portfolio construction will change. Portfolios will become much more complex. There will be instruments that are used that will need constant attention. It's not like buying the index and sitting there. So there's going to require a lot of attention and active management of their portfolios to try to enhance returns.
Well, that's it. I mean, that's an interesting question. It brings up a good interesting question, Chuck. Do you talk about the portfolio structure being stocks and fixed income and then alternatives? And what do you recommend as alternatives? What can people do if they're not going to get a return from stocks, bonds mix? And I agree with that wholeheartedly. My firm published a white paper last year. We actually came up with numbers that were somewhat lower than what you were quoting there with, Callan or JP Morgan or Morgan Stanley. If based on some other factors such as profit margins sort of also come into more long-term norms in that. And of course, the fixed income is kind of, what you see is what you get there. We've been at historic lows in interest rates, not just like our lifetime historic lows, but you could conceivably look back 1,000 years and not find an environment with negative interest rates like this.
That's right. Yeah, exactly.
And it's so crazy. So what are the alternatives? What can you do? And I know I've had people ask me about structured notes, for example. What is there for investors?
Yeah, I think first it's important to look at some of the classic return diversifiers and enhancers, emerging markets, developed country international stocks, real estate, high yield bonds, cash value life insurance. So there are other traditional vehicles that need to be considered. When we do an asset allocation model incorporating a broader array of available equity and fixed income investments, we move the needle from 4.6% to 5.3, 5.4. So that's the starting place, just by having a broadly diversified portfolio. We like private credit and private equity. For years, the only way you could access those is through multi-million-dollar investments in funds that had high minimums. Today, fortunately, there are companies that have developed platforms that allow you to get access to those vehicles at reasonable cost and certainly not requiring millions of dollars. In the private credit area, one platform we use, $250,000 investment would give you access to 3 very well-established long-term private credit type funds. Commodities, hedge funds are very important as an alternative structure. And we are finding that structured notes, as you pointed out, are very popular today, and they're worth talking about. And there are 2 kinds. There are income notes and dual directional notes. These notes are issued by major banks. They're usually for 18 months to 5 years. The income notes usually 18 to maybe 3.5 years. They all have a coupon that is conditional on certain events. The coupons we're seeing today range from 6.5% to 12%. Interest is paid monthly, so that's very attractive, obviously, in today's environment. There are circumstances under which the interest might be suspended for a month, possibly more. The notes are callable typically after 3 or 6 months. So if the issuing bank feels it's no longer going to be able to manage that note profitably for them, they can call it at par, so you'll get all your investment back. And at the term of the note, the expectation is you'll get 100% of your principal back. But having said that, these notes have underliers, as they're called, that are one or more stock market indices. And the movement of those stock market indices might impact whether you get your full amount back at maturity. The statistical probability of not doing so is very low. And if there's a big drop, say 30%, measured from the day you bought the note to the end of any month, if it's, say, more than 30%, in some examples, you won't get your interest coupon that month. But low probability for those events, but they're certainly possible.
Mm-hmm.
We see those as a good component in the fixed income space. Dual directional notes we see as more as an equity replacement, if you will, or in addition to the equity component of a portfolio. And those are also issued by banks. They're notes, and they have a guaranteed return for a time period. So let's say you had a 5-year note, we say we'll guarantee a 40% return at the end of 5 years. So that's roughly 8% a year, discounted present value, 6.5% roughly compounded return. And it's tied to an index. And if that index provides more than 40%, there's no cap. You'll get the 50 or 60 or whatever that index does over that time period. On the other hand, if the index does between 0 and 40%, you'll still get 40%. So you're getting a lot of protection there. Also, when the market's down, let's say in some notes 20%, you'll actually get a positive return if that index is down. And that return might be 5%, 10%, possibly 20%, based on different circumstances. If, on the other hand, the index is down, let's say 30%, in that example, your loss would be 10%. You're protected on that first 20. So, and they mature at par. Mm-hmm. So this is if I could get, when Callan's saying the expected return for the stock market is 6.6%, if I can get that with the note plus have the no cap on the upside, and if I don't earn as much as 40, between 0 and 40, I still get 40, or my 6.6%, and I've got downside protection, that's a win. So yeah,
absolutely.
Understand they're not for everybody. There are risks. I've been oversimplifying the instruments. So investors really need to know and understand the risks involved and so on. But
even though they're bank issued, they're not FDIC bank insured.
That's exactly right.
They're an investment, right?
You're at the mercy of the credit standing of the bank. So that's the credit risk involved.
Right.
I guess I would suggest if JP Morgan goes under and can't stand behind the notes, we have bigger problems.
Could be.
So tell us a little bit, let's talk about active versus passive investing, right? So in the minds of many, this debate was really settled a long time ago in favor of passive, right? On the theory that large cap stocks in particular has the same access to the information, right? It's not possible for active managers perhaps to beat the market, especially after fees are considered. Right. So your firm believes in active management. Can you talk to us about why that is?
Yeah, that's another great question. It begins with the notion that we manage client portfolios with the objective of meeting client objectives. What are their plans? What do they need? And we're trying to provide the returns necessary to get them where they want to go. We're not trying to match the quarterly returns of every index or annual returns for every index and so on. One reason we don't like indexing is that we don't want our clients to participate in 100% of the loss associated with a drop in the index. So then it behooves us to do a lot of research on mutual funds and separate account managers who have stuck to a coherent, consistent style for a long period, who are very good at stock picking. They're looking at what we said earlier, company earnings drive the market. So we look at firms that have a good history and a good process for selecting companies with good margins, good profitability, good long-term prospects, et cetera, any number of characteristics. And in every case, we're using managers that capture a good part of the upside of the market, but capture much less of the downside than they do of the upside. So in the end, over a market cycle, you end up winning by not losing because you haven't gone down as much. So, and these separate account managers are holding 20 to 150 stocks. So they're not going to mirror the index. Now we compare them, how did you do relative to the index, but they're going to be doing some sector allocating, or they're not going to have the same sector allocation that the index will have necessarily. So they won't perform exactly like the index. We find, however, over market cycles, if they're a large cap manager, they've done about what the market has done for large cap growth stocks, for example, or value stocks. So we take some of the volatility out of the process. So we like to think we increase the sleep quotient, if you will, for our clients while meeting their objectives. So getting them where they want to go is what drives us, not beating the market.
That's so important. I mean, the sleep factor, sleeping easy, because as we know, investors underperform the funds into which they invest by as much as 5% per year. And that studies show that year after year after year. It's very consistent because they're selling at the bottom and they're getting out at the top. So if you can smooth that profile so they don't have a deep bottom that they'll panic out of, everybody's rewarded for that. Everybody benefits from that.
Right. Yeah, exactly.
Okay. Well, Chuck, I think we're nearing the end of this here. I know we could go on for another hour. You do a lot of different things for your investors to help protect them, grow their assets, and help them sleep better at night. And I appreciate the time that you gave us here today.
Well, my pleasure. And thanks for having me. We've enjoyed it. Love to do it again.
Very welcome. Thank you very much.
Thank you.
Okay, and now our next guest on Money Matters. Sorry, well, let's see here.
It's on the screen.
Yeah, I just didn't. No, there's Daniela Galdi of Presentation Skills. Thank you, Audrey. And thank you all for joining us on Money Matters, where your money matters.
Great. Thanks. Bye, everyone.